In this part of chapter 1, we will be doing some transaction analysis. We will be using the expanded accounting equation in order to analyze transactions that took place for a certain company. This is a reminder of the expanded accounting equation. Assets are equal to liabilities plus stockholders' equity, and we divide the stockholders' equity further into common stock, retained earnings, revenues, expenses, and dividends. Now, when we talk about transactions, basically what we mean here are economic events that took place at the company. And in order for us to take any transaction into consideration, we have to be able to put a dollar amount to it. As a result, some transactions are not recorded. For example, hiring an employee. This will lead to salary payments, etc. The actual hiring, this is when you sign the contract with the employee, you don't owe them anything yet, so you haven't paid them anything yet, and as a result, this is not recorded as it violates the monetary unit assumption. It's only when you start paying them salaries or paying them an advance or whatever you give them that you start recording the transactions. Now, transactions could be external or internal. When we talk about internal transactions, we talk about the use of inventory, the use of supplies, etc. External transactions, they deal with outside parties such as the company and its suppliers or customers, banks, government agencies, etc. Now, every transaction has a dual effect. And what do we mean by dual effect? It means that it has to affect at least two accounts in the accounting equation. If you have an increase in an asset, that should be basically counterbalanced by either an increase in liabilities or an increase in stockholders' equity could be, or simply a decrease in another asset. Take, for example, buying an equipment for cash. So if you buy a computer for $1,000, your cash will go down, that's an asset, and your equipment, which is also an asset, will go up. Those two, remember that at all times the accounting equation must hold. In other words, assets must always be equal to liabilities and stockholders' equity. Now, the criterion whether to record a transaction or not, it simply depends on whether the financial position of the company has changed. For example, the assets accounts, liabilities, or owner's equity, did these accounts change or not? If they have changed, you record them. If they have not changed, we do not record them in order not to violate the monetary unit assumption. So let's take those for example. Those are events. For example, if we purchase a truck, do we record it or not? Well, purchasing a truck will increase equipment and will, if we buy it for cash, it will decrease cash. So it does affect the accounts, and in this case, we record it. In this case, we record it. Now, when we hire an employee, we do not record it. Like we mentioned before, hiring the employee does not affect does not change the financial position of the company. It's when we start paying the employee that this will change. But the actual hiring, the event of hiring an employee, it is not recorded. When we sign a lease agreement with a landlord, for example, again, the same thing. We do not record that one. Now, when we start paying mortgage, yes, that one is to be recorded because it will change it will have an effect on the accounts. So whenever we think about analyzing a transaction, because of the changes that happen to stockholders' equity, it is very important to keep track of what caused this change? Was it, for example, coming from investment or from revenues? And therefore, we need to analyze each transaction based on its effect on all the accounts that are involved in that transaction. And like we mentioned before, every transaction can affect either side of the equation or both sides sometimes. For example, if you buy cash, if you buy again a truck for cash, then only the assets are affected. We have an increase in equipment and decrease in cash. Same thing applies for supplies. On the other hand, if we buy the truck on account, that would be a loan, or basically, or that would be a liability. In this case, we have an increase in equipment, which is an asset account, and a decrease, and also an increase in accounts payable, which is a liability. So we need to keep in mind that the total assets must always be equal to total liabilities and stockholders' equity at all times. Now we will be analyzing some transactions in order to identify the accounts that were involved and how these accounts have changed. So when we analyze a transaction, the first thing we need to do is to identify those accounts that are involved in this transaction, and then we need to see how they changed. Did they increase or decrease? So the first transaction is where Mr. John Smith opened a law firm during the month of October that he names Smithco. On October 1st, he invests $10,000 cash in exchange of common stock. So the company, Smithco, received cash in the amount of 10,000, and which is to mean that the cash has increased by $10,000. So we add $10,000 to cash, and then that was in return of common stocks. Now, common stock is the investment in the company. And in this case, the amount that was invested in the company increased by $10,000. We need to also write the explanation regarding why stockholders' equity has changed. It is very important to keep track of why this change has occurred in order to know whether this is coming from revenues or whether it was coming from investments. At the same thing applies for expenses, to know basically what kind of expenses we are paying. So here we have issued stock, common stock. Now, the second transaction is where Smithco purchases supplies for $500 on account. So in this case, supplies, which is an asset account, has increased by $500. But we did not pay it directly. And whenever we say we paid it on that it was purchased on account, it means that this is an increased liability. So in this case, the asset account supplies has increased by $500, and the liability accounts payable has also increased by $500. Here the explanation would be purchased supplies on account. And here what happened is that we have more assets, but at the same time we have also our liabilities have increased. As you remember, the two sides of the equation must be equal at all times. And if you look now, those two sides of the equation here are equal to this. They are equal. So the asset side is equal to the liabilities plus stockholders' equity. Now, in the third transaction, Smithco purchases equipment for $6,000 with cash. So the asset account equipment has increased. Now the company has more equipment, but their cash decreased by 6,000. So in this case, we have plus 6,000 for equipment minus 6,000 for cash. And as you can see in this case, the liabilities and stockholders' equity side, the right side of the equation, was not affected. So we had an increase in one asset and a decrease in the second one. Now the fourth transaction says that Smithco receives $4,800 cash from their clients in return of legal services. What happened here is that Smithco provided services to their clients for cash. So what are the accounts that were involved? First, we have cash was involved because they received cash, and then in return of legal services. So basically what we have here is cash has increased by 4,800 and revenues have also increased by 4,800. So those services that were provided are actually revenues that the company has earned. And as we said, we need to enter the explanation to know why stockholders' equity has changed. So we put here that that was service revenues. Once again, the two sides of the equation are equal. Now, Smithco receives a bill of $300 from ATCO for advertising services, but does not pay it until later. So they did receive the service from ATCO. Think about it as ATCO posted an announcement for them. However, rather than paying them directly in cash, they don't pay it now. So what does it become? We have, in this case, an increase in liabilities because now the company owes ATCO $300. And because they received services, they have also, this will also cause a decrease in stockholders' equity. Why? Because this is an advertising expense. So this expense will decrease stockholders' equity. So we have now 300 plus 300 liabilities, and we have minus 300 expenses. That would be advertising expense. In the sixth transaction, Smithco provides John Doe, one of their customers, with legal services for $2,400, but only receives $1,600 in cash, and the balance of $800 is billed on account. Once again, we need to identify the accounts that were involved. We know that they provided services, and that would be service revenue. And they also received $1,600, $800 that are involved. Cash increased by revenue. Smithco of $800 and $100. That are involved in this cash, and as well as rent expense and salaries and wages expense. So what happened to cash? Cash has decreased by $800 because they paid those expenses. So cash has decreased by the total of 800 plus 1100, which is minus 1900 for cash. And then we have rent expense for we have rent expense minus 800 and salaries minus 1100. Once again, the total, and here we have rent expense and salaries and wages expense. Once again, the two sides of the equation are also equal. Smithco pays Atco's bill of $300 in cash. So that was that $300 bill that was here. Now, here in this case, what we're doing is we are paying a debt. Atco is not providing an additional service. As a result, we don't have a new expense. It's not an advertising expense that was provided in transaction 5. Here, on the other hand, all we're doing is we are paying a debt to Atco in the amount of $300. So what happens here? Our cash decreases by $300 and our liabilities also decrease by $300, and that would be for liabilities payment. In the 9th transaction, Smithco receives from John Doe $400 in cash. This is basically to pay part of the debt that they had from from transaction 6. So this is when Smithco provided them with services, and rather than paying them in cash the full amount, they paid them $1,600 in cash, and the remaining $800 was as a debt basically to John Doe. So from John Doe. So basically here Smithco had accounts receivable of $800. Now John Doe is paying back part of their debt to Smithco, and this is why we have here the cash account of Smithco will increase by $400, and their accounts receivable, this is how much money their customers owe Smithco, it decreases by $400. Basically, John Doe, they used to owe them $800. Now they owe Smithco only $400. And this is collection of accounts receivable. The 10th transaction, in the 10th transaction, Smithco pays its shareholders a cash dividend of $900. So they decide to pay part of the money to their shareholders in the amount of $900 cash. So what are the accounts that are involved? In this case, the accounts that are involved are cash and dividends. What happens to cash in this case? Cash will decrease by $900, and dividends will be reducing stockholders' equity by $900. So basically we have cash decreases by $900, dividends will decrease stockholders' equity by $900, and this is cash dividends. Now, if we look at a summary of all the transactions that we had, we can see that the two sides of the equation are equal, and they must be equal at all times.